In this video, I want to go over some simple beginner-friendly options trading techniques that you can start utilizing in the market today. Now, this is our daily market trading recap. Not a whole lot happened today. I took one trade. It was one small loss. So I figured why not dive into some education. So when it's time to actually go about buying our option contract under our options chain, whether you're on Schwab or Robinhood or any broker, you're going to have an options chain. And in that options chain, you're going to see all of the expiration dates for your option contract. Now, with myself personally, well, I trade option contracts that are over 3 days out, so 3 plus DTE, but less than 2 weeks, to expiration. So that's kind of the sweet spot for me, is 3 plus DTE. That just stands for days to expiration, but less than 2 weeks. Okay. So based off your trading style and approach, and for me, it's day trading. It's day trading those contracts that are 3 plus days out and less than 2 weeks out. They give me enough volatility while not being super risky. So if you ever trade 0 DTE, right, that means 0 days to expiration. You're going to see 0 DTE contracts on SPY or on tickers that you're trading on Wednesday or Friday. And it just depends on the stock, how big that company is, and then based off of that, you're going to have various expiration dates. Now, 0 DTEs on SPY, we could be trading every single day. These contracts are going to be super risky and they're going to move very fast. So the closer the expiration, again, we know that those are going to be riskier contracts. We have the potential to make more though, right? So with more risk comes more reward, or vice versa. And so I think for me personally, and if you're day trading, more than likely, you're not going to want to take on the amount of risk that comes behind 0 DTE. We're talking 90+% drawdowns, right? You can lose 99% of your contract's value if you're trading 0 DTE. And even in some other cases, if the stock goes against you, or whether you're long or short, not in your favor, and then they would expire worthless, right? So you can lose up to 99%, and then they're going to expire worthless. You'll lose 100%. So just starting out trading options as a beginner, generally avoid 0 DTE. I was trading 0 DTE at the beginning of this year. I had a couple huge days, but I also had a couple very big red days as well. Now, once you understand that, when we open up the options chain, I'm going to hop back on Tesla. We're going to look to trade, let's say, the October 3rd contracts. Okay, so that's going to be right within our plus 3 days, but still less than 2 weeks out, October 3rds. These contracts, we're going to be able to limit our risk a bit, but they're still going to have a lot of upside. And then it comes down to choosing your strike price. So our strike prices, obviously, got our calls on the left, our puts on the right. And when it comes to choosing a strike price, we want to then understand the next degree of risk we're putting on. So first it's expiration, second it's strike. So anything that's highlighted in blue, these are going to be in the money contracts, in the money, you could see, and anything that's in black, these are going to be out of the money contracts. And all you need to know is that the in the money contracts, so the blue contracts, are going to be safer. The out of the money contracts, so all the black contracts here, are going to be riskier. And so when we're looking at taking a trade, if we choose contracts that are, these are the October 3rds, October 3rd, those are going to be 9 DTE, not super risky. They're not 3, they're not 4, they're not 5. They're kind of in the middle between our 3 and 2 weeks. So we could maybe put on a little bit more risk. If we're trading calls, which means we're betting on that stock to go up, that means we would maybe look to trade contracts that are slightly out of the money. So this would be 1 contract out of the money, 2 contracts out of the money, 3 contracts out of the money. And if you're trading puts, it's the opposite. This is going to be 1 contract out of the money, 2 contracts out of the money, 3 contracts out of the money. Now, let's say instead of trading the October 3rds, we're trading the October 10th contracts. Well, those are going to be even safer. Let's balance that out by buying even further out of the money. So you can start to see how you're going to balance both the expiration date, okay, with the strike price. So EXP with strike. So if you're trading contracts that have a closer expiration date, you're going to want to go with a strike price that is further in the money, right, in the blue. Now, on the other hand, if you're trading contracts that have a further out expiration date, these are going to be safer. Well, we could look to trade contracts that are further out of the money, right? So they're going to be a little bit riskier. So you can kind of balance the strike and the expiration. Now, if you want to be super safe, you'd trade contracts that are really far out and into the money, right? If you want to be really risky, you trade contracts that are super close and they are super far out of the money, okay? And so for me, it's normally finding that balance. And again, within that desired DTE range, and typically 3 to 5 places outside of the money. I'm going to be a little bit more on the riskier side. So I'll look to trade, let's say, for example, if I was trading Tesla and I wanted to, buy some Tesla calls, I'd be looking at the 445s, 450s, and then 450, 250s start to push it. Those are the October 3rds. And the same thing goes if I was short. We're going to look 3 to 5 spaces out of the money, okay? Now, with that said, when you go to actually buy that contract, you're going to want to look at the history, and you're going to want to see what those contracts have been trading for on that given day. And so specifically, let's look at the October 3rd 445 calls. These are the October 3rd 445 calls. And you can see here, this chart is going to represent those actual option contracts. So this was the beginning of today, and we can see the end of today. You can obviously tell here by looking at the contracts, just like you would look at a stock. If it's trending from the bottom left to top right, that means that stock is going up, right? It's a green day. That's bullish momentum. Now, prior day, look at this. Contracts were getting less and less in value. So that means, well, Tesla was probably selling off throughout the entire day. So very bearish day for Tesla here. And so we could see today's peak on these contracts was about 1627, okay? And we know with options, if it's 1627, that's $1,627, right? Because we're gonna move our decimal point there. Options are leveraged 100 to 1. Looks like the low was the open around $10 or $1,000, right, per contract. Now, if you're using Thinkorswim, you're probably going to see the theoretical option price. I would remove that, and you can remove the open interest as well and hit apply. This will clean it up a bit. I should have done that to start with, but we're going to use this chart, which is just going to be chart 3. You can just look at the option contract code. It's pretty easy to do that. When you're in the options chain here, you're going to right click on the ask side and click on copy, and then you're just going to paste it into here as if you would look up a ticker. Or you can change the color here to say yellow, and you're going to right click under the buy side and you're going to go send to yellow. Or if we want to look at the puts, you're going to go send to yellow. Right? So these are the puts. So the puts lost value during the day because, well, puts go down. That means that Tesla is going up. So let's go back and look at the calls. We'll send these to yellow. And again, make sure you're clicking under the ask side. Now, the market is closed, but when it's open, we're going to use the T and S. That means time and sales. So we're going to have the time, the price, and the size. So we're going to be able to see when those contracts are being bought and sold. And this is going to be super helpful, and this is something I do whenever I go to enter a trade. So let me show you what it would look like in a live scenario. This is just a screen recording from when I was trading during one of my live sessions. Now, I trade every single morning live in front of my mentorship group. I give my students access to see and copy my trades. If that's of interest, I'll put a link in the description below. But you can see here how we could see the price, the size, and the time. Now, you can rearrange these if you want time first or price last. It doesn't matter. Now, under price, that is the price at which the contract traded at. Under size, that is how many contracts were traded, and then obviously the time those contracts were traded at. This is when I was in Europe. So you can see here, the most recent transaction, we had someone selling one contract at 95. So that's $95. It looks like 95 cents again. Now, prior to that, we had 6 people. You can see here how it says 6 selling at 98 a contract. Prior to that, we had 49 people buying at $1 per contract. Now, we want to see what those recent contracts have been bought or sold for, because like in anything in life, when we go to buy something, we want to make sure we're getting a good deal. And so this is a market, it's a marketplace. We're exchanging contracts between one another. And so we want to see what those recent contracts have sold for or been bought for, because a lot of the time our spread, and when we look at the difference between our bid and our ask, well, you can see here on these contracts, we've got 1680 and 1685. Sometimes this spread will get wider apart. Maybe we'll have 1,600 and we'll have 1,800. So that's a $200 difference, okay? And the only way you can really know what the true fair value of those contracts would be at that time, because there's a lot of manipulation that goes on, big orders come in, it's gonna, change the spread and what those contracts are priced at. It's not using theoretical price, it's looking at time and sales. So maybe you're looking here and you're like, okay, maybe I could get filled here at 1680, but someone in the time and sales, they just got filled at 1650. Put in your order for 1650. Now I'm gonna play this live example for you guys. It's about 1.5 minutes long, and you can see what this really looks like in practice where I actually enter and get filled. So spreads are gonna get some of you guys in trouble, and I'm gonna show you how. I'm gonna show you why. Because this order just came through on ANET. Now tell me how. These are puts. ANET has gone up, but the value of the contracts are more than what the buyer got filled at. Makes no sense. I have a limit order in now at 85 a contract. I, for the example, put in $500 and got filled at the time where the order came in, you guys were entering. All of a sudden the spread changed, right? Fluctuated. We went from 90s, 85s, 90s up to 100. And now I'm down 11%. So the buyer got filled at $85 per contract. You guys started buying at $1 per contract. That's a 15% difference. I say don't sweat the entry. That's one thing. This is how you're gonna get yourself in trouble. You just lost 15% for no reason. This doesn't make sense. How did the buyer come in short here? The contracts are up 15%. These are shorts. They should be down 15%. You gotta watch out. You gotta keep an eye on the spreads. This is you guys, and you're essentially manipulating the spread, and you're doing it like at the same time we're all getting in at the same time. So you're harming each other in a way. If you're being stupid and going in with a market order on a spread like this and paying $1, now everyone looks and they're like, oh, $1's fair value? No. Think about it from a logical perspective. I have my limit order in here for my actual position at 85, which will get filled once you guys stop buying up market at $1. So go in with a limit order, okay? Don't want to see you guys missing, losing out, giving away, however you want to put it, 10, 15, 20% off an entry, right? That's not sweating the entry, that's trading. Now, with that said, if you guys are interested, like I said, in copying my trades, I'll put a link in the description below. Subscribe for daily uploads. Leave a like if you got any value from this video, and I will see you guys in the next one.